Mutual funds are a brilliant concept when you think of it, but there are some really big problems that come along with owning a mutual fund. Find out why we don't put any of our assets that we take care of into mutual funds next on Consider This Program.
Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Jamie Burton.
Happy to have you along. Jamie is one of our senior advisors up in the Lafayette, Indiana marketplace, and always happy to have you here on the show with us. We are... The Financial Enhancement Group is going to turn 25 years old this year. And when I got into the industry, it was 2 weeks before the crash in 1987. Some major things had changed and taken place, not to mention the huge amount of market volatility we saw Black Monday. But when I had to, I literally had to teach myself the industry. I come from a family that had no real wealth. They were all school teachers, or all trained that way. And back then, the 403B market really hadn't started a lot. So most people still had pension plans, didn't really understand investing in the common household. It certainly wasn't a topic at our dinner table. So I had to teach myself the industry, and it became very, very clear to me that mutual funds made a lot of sense in the past, but not a lot of sense in the present. And as we've gone further and further through time, that has been the case. So I know most of you understand what mutual funds are. Disappointingly to me, most of you own mutual funds inside of 401k plans. We have one of the only 401k plans that I see that only has exchange-traded funds. It's because yours truly is hard-headed. But let's walk through this little bit of history. Jamie, tell me what a mutual fund is.
Yeah, so a mutual fund is an investment vehicle where there is a pool of money that is an accumulation of different investors putting money in. And inside that mutual fund, you're investing in stocks, bonds, or cash-like alternatives. And then you have a professional money manager who is managing those assets inside that mutual fund. And each mutual fund has an objective that they're trying to achieve with the assets they collect from the different investors.
Do you remember when mutual funds were started?
No.
1923. We had a huge market crash in essentially 1921. And you know what? You weren't around. I wasn't around, but we had the Roaring 20s, it was called, and everybody wanted to be invested in the market.
Okay.
And you had, Western Union, but you had no fax machine, no email, no nothing else, right?
Right.
And you had to find somebody like us who had the licenses to be able to buy and sell securities in Chicago, Philadelphia, New York, or Boston, right? And it was just impossible. So I showed you when you were at Purdue, my little Hooks paper. And you got to be really old to remember Hooks Drugstore, which is now CVS, and there was a couple in between. But when I was a paper boy, I would go get my little green sheet, and I would have down the Burton family, and I would mark whether you had paid me for the week for the paper or not. Mm-hmm. And that's essentially what happened with mutual funds. Instead of me having to keep track of all of the individual investments that you had, I created a trust, and you were able to buy a unit of the trust, and that unit was divided up between all of those stocks, bonds, and cash things that you had, right? As you said, a brilliant, brilliant idea. Now, what happened in 1983? That was when Excel was created. Okay. And suddenly I didn't have to go back to Hooks to buy the green to be able to keep track of it, right?
Okay,
So the idea, you are substantially younger than I am with three young kids. Barb and I are empty nesters, right? And the idea that we would put our money together without knowing each other's objectives really didn't make a lot of sense in the first place, right? But then you have the tax complications that go with that. So let's leave the IRA and 401k out of it for a second. Mm-hmm. Talk to me. What happens if I buy a mutual fund? You and I are in an investment together, and we buy this mutual fund. What happens from a tax perspective?
Yeah. So inside of the mutual fund, the money manager is buying and selling different securities and bonds. And when those purchases and sales happen, there's going to be gains, there's going to be dividends, there's going to be different things that happen from an income standpoint. And instead of the mutual fund paying for those taxes, those gains get pushed onto each individual that owns the mutual fund. It gets pushed onto their tax return. So even if they're holding this mutual fund and they haven't made any sales on their own, they're going to be recognizing this income and these dividends.
Now, I hear the person inside of the money managers, you called them, I hear they're a fiduciary. Isn't that the same thing you are?
No, I would say no.
Why aren't they fiduciaries?
Well, the money managers are working for the company that they work for. They're not working for the best interest of the people that own the mutual funds.
They're working for the interest of the trust.
Yeah.
Right. And that becomes very, very confusing to people. So every now and then somebody will call in and say, well, I talked to my advisor and we have 10 fiduciaries, not just you. Right. And it's kind of like, no, you have 10 mutual funds that you're paying a tremendous sum to, right, that have, an express responsibility for that trust. But we got into one of those concepts that I still have to explain to people on the tax side, about every year is what is a phantom capital gain and how does that work? You almost said it out loud, right?
Yeah. So a phantom capital gain is when capital gains get pushed onto individuals' tax returns when they haven't sold anything to accumulate any capital gains, but they still owe the taxes on it.
So, but that's a real capital gain. In this case, where phantom gains become very, very frustrating is let's say it was January 1st of 2020, right? And we were going into the pandemic year, even though we didn't know it. And the market was up pretty much the first week of March, quite substantially. So you bought a mutual fund, let's just say it was at $10 a share, right? So that what the net asset value would be $10, right? Yep. And then all of a sudden we had the great downturn in March, right? And all of a sudden on paper, your NAV is now $7.50. You've lost 25% of your money, but you didn't sell anything. Right? But that doesn't mean that the fund manager didn't sell other stuff along the way. So on paper, you can have an unrealized loss, one that you didn't recognize because you didn't sell, and still have to pay the long-term capital gains, even though you'd only been in the fund for a month or two. That's where the phantom part comes into play. Inside of a mutual fund, you still have the real capital gains, right? The fund manager bought Apple, right? And sold Apple, and you get experience a long-term capital gain. That's just part of being a shareholder. It's the phantom ones that really, really get ugly. So why do we use exchange-traded funds instead of mutual funds?
So the problem that we see with mutual funds is that they are expensive. So typically you either have a charge on the front end or the back end when you sell a mutual fund just to be in the fund. And then you have really high management fees inside the fund going forward. They're called 12B1 fees. So those are fees that you don't really see, but that we know are associated with mutual funds. Instead of using mutual funds, we use exchange traded funds. The reason that we do that is because we can still get the diversification that we're looking for. We can invest in the things that we know we want to have in our portfolios. Exchange traded funds are much, much cheaper. They're free to invest in. We work with TD Ameritrade, and through there we get to invest in those for free. Then they have very, very low carry forward costs from there, and they're very transparent. We know exactly what is inside that exchange traded fund and why we're investing in it.
And this is one of those scenarios, folks, where I think things have changed and people kind of missed it. When I got into the industry in 1987, it was $300 to make a stock trade. Right? Jamie just said free. I got to unpack free for a second, but it was $300 to make a stock trade. In 2000, it was $70 to make a stock trade, right? By the middle of the 2000s, it was down to about $35. And with our contract, because of the amount of money we manage with TD Ameritrade, they really are commission-free exchange-traded fund trades that we can make. Still have those little costs that are inside. But there was a period of time where if you didn't have a large sum of money, investing in individual equities was cost prohibitive. You were better off to be in a mutual fund. We didn't use them. We used what was called unit investment trust, which now became exchange traded funds. It was better for the families we served back then. But what I'm trying to tell you is over my 34 years of being in this industry, 25 years of being the co-founder at the Financial Enhancement Group, if you think everything has stayed static, or if your portfolio stayed static, the decisions that you made 24 or 25 years ago, I'm telling you, watching it every day with our team of 38 people, right? Almost 1,100 families we take care of. When we look at this, there are stuff that is fluid in the tax code, the investment world, wherever you want to go, that's constantly changing, and you've got to be able to update what is going on. So years ago, I told people buying mutual funds made no sense. I got written up in the media as being not so smart. Purdue professors who challenged me and, like crazy. You wouldn't even believe it. The Morgan Stanleys of the world said, what are you talking about? Today, the largest owner of exchange-traded funds are the mutual funds themselves. And that is because of the efficiency that they're able to get into. So tell me real quick what overlap is, because that's one of my other big frustrations.
Mm-hmm. Yeah. So when you are purchasing a mutual fund, typically if somebody has one mutual fund, they have 7 different mutual funds. And this is where the whole transparency thing comes in. If you were to pull up the top 10 holdings of each mutual fund that you own, the majority of them are going to be the same top 10 holdings. So when somebody is purchasing these 7 mutual funds, in their head, they're thinking, I'm diversified. I feel good. My money is spread out where it needs to be. If one thing happened where a company tanked and lost all its value, I have all these other assets that I have in different places, so I'm going to be okay. But when you look and they're all the same, then you're not really diversified.
Well said. And that's the problem, especially in a heavy traded market. And I know some of you out there own index funds like the S&P 500 that John Bogle at Vanguard really kind of pioneered. And a lot of people say, hey, I am diversified. I only own the one. There's cheap expenses. Bogle, about a month before he passed away in 2019, actually said it doesn't work anymore. And the reason he would tell you that is the top 5 holdings in the S&P 500 today make up almost 20% of the value of the entire S&P 500 fund. You are overweighted even if you're in an S&P 500 fund. Call 800-928-4001. Go to our website at yourlifeafterwork.com. Get signed up for a Next Steps meeting. If you want to know more about the market and the things that are going on there, get a hold of the Market Carver. It's a video that I send out or our Chief Investment Officer sends out every week that keeps you updated on what's going on in the economy and the market. Again, it's 800-928-4001, yourlifeafterwork.com. Sign up for a Next Steps meeting and ask Brittany to get you set up with Jamie or Grant or Dean or Aaron.